Ladies and gentlemen, welcome on board Flight 89B with service from Singapore to New York. We are currently third in line for takeoff and we are expected to be in air in approximately 7 minutes' time. Today, we'll be having a special flight where you will be able to watch on your screens our company's management team answering some questions most of the shareholders have been asking. Thank you for choosing Singapore Airlines. Enjoy your flight.
Good afternoon. Can you first introduce the Singapore Airlines case of rights issues during the COVID-19 crisis? On April 30, 2020, Singapore Airlines shareholders were called up to vote for capital raising measures of up to 15 billion Singapore dollars due to the global financial crisis in the airline industry caused by COVID-19. So, after the reduction of nearly 96% in Singapore airline capacity, the company revealed a rights issue strategy up to 5.3 billion Singapore dollars in rights offer, meaning that existing shares will be diluted due to newly issued discount shares. The company then offered up to 1.78 billion new ordinary shares at an issue price of 3 Singapore dollars per share, which implied a discount of 53.8 to the last transacted price. Singapore Airlines also announced the offering of mandatory convertible bonds in the amount of 3.5 billion Singapore dollars. So every 1,000 Singapore dollars invested would be converted to about 3,073 shares at the end of the mandatory convertible bond maturity. Once the security at a conversion price of 4.84 Singapore dollars, associated with a mandatory conversion of 1.81 Singapore dollars at maturity date. Therefore, if those measures were admitted, Singapore Airlines shareholders would have to decide whether to subscribe to the shares and mandatory convertible bonds or rather let them lapse without exercise. Nevertheless, after presenting the capital raising measures, we are now going to get into more detail about these strategies and if they were sufficient to tide over the airline. Great. Now I'm going to ask you 7 questions regarding the case that investors would really like to see them answered. Firstly, can you analyze Singapore Airlines financials relevant to raising funds?
Hello everyone and thank you for the question. Regarding Singapore Airlines financials, we will be using the earnings per share, the debt to equity and the interest coverage and compare it to the industry numbers. To get the industry numbers, we used 4 companies, the Japan Airlines, Air France, China Eastern Airlines and Delta Airlines. Starting with the earnings per share, we can see that Singapore Airlines always has its values between the range of -2 to +2, while the industry values fluctuate a lot more. By the end of 2021, it looks that Singapore Airlines is in a better position than the industry, even though their net income decreased by over 4 billion Singapore dollars. This happened because this ratio can easily be manipulated by a stock split, a stock merge, or by just issuing new shares. As we can see, this is what happened with Singapore Airlines as the shares outstanding increased by 2.5 times. Knowing this and using the previous value of shares outstanding, we can estimate what will be the normal earnings per share. Now, it does not seem that Singapore Airlines have a clear advantage over the market, and we can clearly see how this ratio can be manipulated by companies. Looking on to the debt to equity ratio, we can see that in the first year, Singapore numbers were really close to the market, but skyrocketed in 2020. Despite that, there was a huge reduction in 2021. On a first thought, we can think that this happened because there was a huge reduction in debt, but this cannot be further from the truth. As we can see, there was a debt increase in 2021 and it was around 1 billion Singapore dollars. The reason the debt to equity ratio decreased in this year was because of previously mentioned increase in shares outstanding and the slight increase of the share price on that same year. Moving to the interest coverage ratio, as we saw before, the debt increased a lot in the last few years and logically the interest expense followed that trend. With COVID and the lockdown, all airlines saw a huge decrease in their operations, causing also a significant reduction on their EBIT. With both these factors in play, not even Singapore Airlines, that had a huge ability to pay their interests, was able to sustain these conditions, reaching a negative value of interest coverage in 2021.
What is the difference between a rights issue and a typical share issue? Before getting further into our analysis, it's important to establish the difference between a rights issue and a typical share issue. A rights issue is an offering of rights to existing shareholders to incentive the purchase of additional new shares in the company at a discount on the market price on the stated future date. This means that the company is giving shareholders an opportunity to raise their exposure to the stock at a discount price. On the other hand, in a typical share issue, the company issues and sells additional shares to the market participants, making the issue shares a subset of authorized shares that have been sold to held by shareholders. What is the difference between mandatory convertible bonds and a typical convertible bond? Additionally, there are also differences that should be addressed regarding different types of bonds. A mandatory convertible bond automatically converts to equity on or before a contractual conversion date. So, by presenting a required conversion, it can guarantee a certain return. On the other hand, a typical convertible bond gives its holders the option to convert it for a predetermined number of shares with a slightly lower interest rate when compared to regular corporate bonds. Why is Singapore Airlines issuing rights and mandatory convertible bonds instead of borrowing money or issuing a seasoned equity offering?
Well, as we described before, issuing rights and mandatory convertible bonds are two raising capital strategies that are significantly different from typical loans or seasoned equity offerings. From the company's perspective, issuing rights can be perceived as a good option to raise capital since the company does not incur additional debt with possible high interest rates. Therefore, it was helpful to cut the company finance costs during the COVID-19 pandemic. Then, this option provided one part of the necessary liquidity faster and without payments of interest. Similarly, the second strategy used, mandatory convertible bonds, gave the company the possibility of raising capital without immediately diluting their shares or without diluting their shares at all, if the company redeemed the bond until the conversion time. As a result, Singapore Airlines managers consider issuing convertible bonds as a safer option. To conclude, we can suggest that Singapore Airlines prefer to issue rights and mandatory convertible bonds instead of issuing equity offers since they believe that the final cost for the company by adopting that strategy was lower compared to other forms of raising capital. This strategy reinforced the company's future balance sheet, was allowed it to manage the capital raised as equity instead of overloading it with high levels of debt that could prevent the company from financing in the future.
How would you price Singapore Airlines shares X rights?
So, hello everyone, and thanks for the question. The term X rights refer to shares that are trading but no longer have rights attached to them, no longer providing the holder any special privileges. X rights shares are worth less than shares that are still trading come rights, not yet X rights, because they do not give a shareholder access to a rights offering. Explaining what an X rights share is, it is possible to price Singapore Airlines shares X rights. For that, we use the theoretical X rights price, which is the market price that a stock will theoretically have following a new rights issue. We can calculate the theoretical X rights price immediately following the last day of a stock's right offering. This calculation gives us the value of an individual share after the offering. So applying to Singapore Airlines, according to the information given by the case, the last transacted price on the day before the rights share issue announcement was 6.5 Singapore dollars. There were issued 1.78 billion shares, being the rights issue based on 3 rights shares for every 2 existing shares. This means that before the issue, there were already a number of ordinary shares in circulation, represented by 2/3 of the number of rights shares. The new ordinary shares were announced at an issue price of 3 Singapore dollars. Finally, the Singapore Government Investment Temasek Holding Limited decided to guarantee the success of the issue by promising to take up all unsubscribed rights shares, which means that 100% of the rights issue shares will be sold. Having these considerations given by the company in mind, we are able to know the information that you can see in the screen. Knowing all these values and applying the formula explained earlier, we reached a value for theoretical X rights price of 4.39 Singapore dollars. Thank you.
If you were a current shareholder, would you vote for the rights issue and mandatory convertible bonds? Would you subscribe to the rights issue?
To answer that question, it's important to mention that Singapore Airlines seek to create sustainable shareholder value by maximizing returns for long-term profits. The company represents an important role in Singapore's economy, and we believe the current management team to be efficient. In 2020, the company needed funding, otherwise it could bankrupt. If that happened, shareholders would lose their invested money. On the other hand, by helping the company, shareholders can end up profiting as the company thrives in the future. That being said, we, as shareholders, we would vote for capital raising measures. We would also subscribe to the shares and MCVs due to four main reasons. The first one is regarding the airline's reputation. The company wants to maintain that good reputation, and therefore we believe asymmetric information is insignificant, and consequently we believe the money will indeed help the airline to prosper and gain even more competitive advantages in the future. Secondly, the success of the issue was already guaranteed by Temasek, and so the risk of subscribing and afterward the issuance failing is very low. Besides, having an investment company willing to do that is indicative of the airline's future potential. The third reason is regarding airlines policies we previously presented and also the current management team we strongly believe to be efficient and professional. Last but not least, the economic repercussions associated with the bankruptcy of Singapore Airlines would be so disastrous that the government wouldn't allow that to happen, and so the company can be seen as too big to fail since it is a key pillar of the country. This could actually be a wake-up call as it could lead to lower efficiency. However, that, aligned with the three other reasons we presented, leads us to believe the company will have a successful future that we clearly want to be a part of.
If you were a current shareholder and Temasek did not guarantee the remaining issue, would you vote for the rights issue and mandatory convertible bonds? Would you subscribe to those securities?
Our decision as shareholders about voting for capital raising measures would remain the same and for the same reasons, since the company could struggle a lot more without being able to raise capital as equity and having, for example, the need to contract debt at high rates. About subscribing to the shares and MCBs, note that we previously presented four reasons for why we would subscribe. In this new scenario, only the second reason we presented suffers some changes. Temasek here doesn't guarantee anymore the issuance success, but the company still subscribes to its own entitlements. So even if the operation is riskier for us, Temasek wouldn't put more money in Singapore Airlines if the investment company didn't believe this aviation sector would be able to recover from this crisis. Also, the first, the third, and the fourth main reason remain exactly the same, and therefore, even without Temasek's guaranteeing the remaining issue, our decision as shareholders that want to profit in the long term will be to subscribe to the securities since we believe in the company's future success.
Dear investors, I really hope this interview helped you to understand the company and its potential. Thank you all for your attention and see you next time.
Ladies and gentlemen, welcome to John F. Kennedy Airport. Local time is 9 a.m. and the temperature is 77 Fahrenheit degrees. On behalf of Singapore Airlines and the entire crew, we'd like to thank you for joining us on this trip and we are looking forward to see you on board again in the near future. Have a nice day.